But as you guys know, is that I am a gold bug. You know, I like gold. I've been a gold bug since 1972, the year after Nixon took the dollar off the gold standard. And I was in Vietnam at the time, and I was watching the price of gold climb from around 35 and up and up and up. And I've also saw it go to 800 and then retrace back down to 300. So as you guys know, we've had our friend, and we have a lot of gold bugs on this program who are very favorable gold, and we have people who have anti-gold. And the position at the Rich Dad Company is that all coins have three sides. You have a heads and a tails. You have a pro and a con. And your job is to be on the edge of the coin, the third side, and listen to the other sides, and then you can understand. So today we have a very special guest that's been on with us before. He's Harry Dent, and he's one of the most accurate forecasters I've ever read. I read his books, and he talks about the great boom ahead and all this, and he's been so accurate. But in his latest book called The Demographic Cliff, How to Survive and Prosper During the Great Deflation of 2014 to 2019, he's calling for gold to go to $250 an ounce. And then, as you know, we've had one of our other friends, James Rickards, our author of Currency Wars, and he talked about gold going to $10,000 an ounce. So here on one side, you have a very knowledgeable individual, very smart man, James Rickards, calling for $10,000 gold. And the other side of the coin is equally a smart man, Harry Dent, and he's calling for $250. But let me give you this. It's about standing on the edge. It's not the price of gold. It really doesn't make a difference if it's 200 or 10,000. What you're going to hear today is why. You know, you heard why Rickards said it's going to go to 10. Now you're going to hear from Harry Dent to say why it's going to 250. And your job is to stand on the edge. Anyway, your job at the Rich Dad Radio Show is to listen to both sides. It's not the price of gold, but it's the logic and the reasoning behind price. Any comments, Kim?
This is how you, the listener, get smarter about the economy, because it reminds me of being in a legal dispute, or like in college, you had college debates. And so you hear one side and you go, wow, that makes really sense. Yeah, I'm all for that. That's perfectly logical. Until you hear the other side. And you go, well, that makes sense too. And so as an economic investor, as a business person, you really do need to hear both sides, because both sides have very valid points. So I'm very, very excited about Harry Dent. Harry has a new audiobook called How to Survive and Thrive During the Great Gold Bust and Ahead. And he is, to me, the king of demographics. So along with gold, I do want to ask him about the Dow and the impact of Brexit. And, of course, we can't leave today without talking about our dear friend Donald Trump.
So anyway, as you know, in Rich Dad, Poor Dad, I created my controversy by saying there's good debt and bad debt. And most people only see bad debt, but they fail to realize that the U.S. dollar is basically debt. And so they're trying to save a dollar, you're trying to save debt. And that's my logic for affecting gold. You know, if debt is debt, then what is real and what's not real? So we're going to go into why some people think gold is real money, which is James Rickards, and Harry Dent thinks gold is just a commodity, like toilet paper. Harry, welcome to the program.
Welcome, Harry.
Yeah, nice to be back, guys.
Oh, nice to have you back.
So tell me, because I can't wait, because I'm a gold bug. Tell me why you're wrong.
Okay, first of all, Jim Rickards can say gold is money, but since early 70s it has not been, and try to take a Krugerrand down to the convenience store and buy something with it. You will not be able to. Second, gold was a great standard and backer of currencies up through the 1800s when we were largely a commodity economy, and it was just like the rest of the economy, just more concentrated in value and revered, so it made it a good backer. But it correlated with that economy. From the 1900s and especially the last several decades, I mean, we've become a total information economy, healthcare, technology, financial services, all these things. In the United States and modern countries, 3 to 5% of our spending is on commodities. It is not representative of our economy. It might be in emerging countries. And third, all the gold in the entire world could fit in an Olympic-sized swimming pool. How are you going to back a modern-day economy that is so much larger, so much more complex, and so much less commodity-focused on gold? So gold, we do need a standard. We've gone off standard since early 70s, run deficits in government and higher private debt and trade deficits ever since. That's why you need a standard. I'm just saying gold will not become money again or a backer of currencies because it's not capable in this time. But we do need a standard badly.
And what is that? Do you have an idea what that standard might be? Are you saying it's, to me, money today is just an idea?
It is. And basically it has to be very strong policies or laws that literally say governments and private debt, because governments don't create most of the debt in the economy. Banks do, lending to households and financial institutions and businesses. There's 3 to 4 times the government debt. So we have $67 trillion in total debt when everybody's worried about the 18 to 19 in federal debt. So money gets created, and there has to be standards that basically the Federal Reserve should have a standard that says, look, we don't allow banks or the government to create debt much faster than the growth of GDP. And we've been creating debt, private and government combined, since 1983 and into the last bubble for 26 years at 2.54 times GDP. That is insane. That is a debt bubble guaranteed, and debt bubbles create financial asset bubbles in stocks and real estate and commodities, and then they all crash when that debt has to start deleveraging and we can't support it anymore. This happens every time in history. The problem is it only happens about once in a lifetime. So when the next debt and asset bubble like this builds, the first one since the Roaring '20s and the Great Depression followed, nobody understands it, and everybody's getting a free lunch. The real estate's going up 20% a year. Their stocks are going up 20% a year. They're doing nothing, getting rich. Who doesn't like that? It's like going to heaven, And so people get blind, and they don't want the bubble to end.
But Harry, let me give you this, okay? Because again, all coins have 3 sides. So a guy like me looks at your argument, and I agree with your argument. But that's a reason to buy gold.
Well, okay, if you look at gold, number one, what gold correlates, and I'm talking about all the way back to the 1600s, they've charted this. Gold correlates with one thing consistently over time: inflation. Not growth of the economy, not debt or anything else. Now, high debt will tend to cause higher inflation, although it doesn't always, because we have the highest debt in history now and near zero inflation. And in the late 70s, we did not have debt anywhere near comparison today, and we had the highest inflation in history. But gold is an inflation hedge and correlates with inflation. We've seen nothing but disinflation since 1980, and that's why gold largely came down. It went up strongly with the commodity cycle. It started to boom in the early 2000s, and then it accelerated even more than most commodities after 2008 when governments started printing trillions and trillions of dollars. Well, gold's thinking, and I would have thought the same thing at the time, well, all this money printing is going to cause inflation. But our argument is you don't understand, when debt bubbles start to deleverage and shift the other way, money is destroyed. Debt, as you said, is money. Banks create debt out of thin air when they make loans. When now governments are creating money out of thin air with quantitative easing. This is creating more and more money. When debt bubbles deleverage, money gets destroyed. Bubbles burst. And a Dow that was 20,000 one day now is 3,000 or 4,000 and doesn't get back to that level for 20, 30 years. That's what happened from the 30s forward.
Okay, once again, we're talking to Harry Dent. He's infamous for the book, The Great Boom Ahead, and he was right on schedule. He is a demographer, which means he looks at demographics. And his words are demography is destiny. So when you look at what's happening, and what's happening right now is you've had the baby boom generation, and they've been the richest generation in history. Now they're starting to retire, and they're going to possibly bring the whole thing down. The difference here is this. We look at the same data. Everything Jim is saying, and Jim Rickards of Currency Wars would say that would drive the price of gold up. And Harry Dent is saying the price of gold will come down. Any comments, Kim?
Yeah, well, here's that question I have, Harry, because we talk about all the debt, and the banks are creating all this debt, and there's all the printing of money. Hasn't it all been based on this word called growth? It seems to be like the sacred cow is growth. We have to have growth. We have to have growth. We have to have growth. But growth seemed to go away from business and jobs to Wall Street.
Yeah, speculation. That's not growth.
Yeah.
Speculation never lasts. It's like Robert said before, there's good debt and bad debt. There's good growth and bad growth. The same with the debt and the same with growth. When businesses are investing in productive capacity that is needed to supply greater consumer demand, and that creates more demand and augments consumer demand, that's good investment, and borrowing to do that is good borrowing. Here's what kills me about the gold bugs. All my presentations, Peter Schiff, Jim Rickards, when I debate them, we have the same charts about debt and debt bubbles. They don't study in history what happens when the debt bubble actually bursts. Debt bubbles always see deflation, no exceptions. I mean, zero, no exceptions in history. And when you see deflation, all money goes down, all assets go down, debt deleverages, and even gold goes down in that case. Everybody's thinking gold. Hey, gold was the best, did the best in the 70s of any investment because it was an inflation hedge, and we had the highest inflation in history. Now, after the greatest debt bubble in history, and it's not just U.S. and Europe, it's China and everybody else, it's global, it's emerging market, we're probably going to see the biggest deflationary period in history. Gold correlates with inflation, period. In gold, for some reasons, it is kind of a crisis hedge to some degree, but I also ask people, what was the greatest crisis we had in recent times? When the whole banking system melted down and Lehman went under and AIG and and General Motors about to go. That's just like the Great Depression. What did gold go do in the last half of 2008? It went crying for mommy. It went down 33%. Silver went down 50%.
Hey, when we come back, again, we're talking to Harry Dent, and I'm glad we don't have Peter Schiff, Jim Rickards, and Harry Dent on the same program.
We'd have,
I tell you, there would be no conversation. They would be yelling. But anyway, this is fascinating stuff. Again, as Rich Dad always said, all coins have three sides, heads, tails, and the edge, and he's exactly correct. Everybody uses the same charts. It's like reading the tea leaves. Because today's program is a very important program. Our special guest is Harry Dent. And Harry is an economic forecaster. I remember his book years ago, The Great Boom Ahead, and he was right on schedule. And his latest book is called The Demographic Cliff, How to Survive and Prosper During the Great Deflation of 2014 to 2019. And the reason this is a very important show is because I am a gold bug. I've been a gold bug since 1972. But I am a gold bug for different reasons. And we've had people like Jim Rickards, who was calling for $10,000 gold. And here we have Harry Dent, equally as smart, if not smarter in different areas, but he's calling for gold to $250 an area. And as I say it again, it's not the price of gold, $250 or $10,000. It's the logic, it's the reasoning, it's the wisdom behind the predictions. And as my rich dad often said, all coins have three sides, heads, tails, and the edge. And the Rich Dad program, Rich Dad Radio program, is designed to have you stand on the edge so you don't get one point of view. Any comments, Kim?
Yes, well, Harry is the author of the book, The Demographic Cliff, and I don't know anyone smarter who uses demographics to predict the economic future. So I want to go right to you, Harry, and in terms of demographics in the U.S. and globally, what do you see happening in the U.S., and does that also transfer globally regarding demographics?
It does. The baby boom happened around the world, and I discovered in the late 80s that through a lot of demographic research, that the average person in this country literally peaks at age 46. They enter the workforce at 20, raise their kids, buy all their houses and cars, do all their borrowing, and then they're done. I mean, they keep spending on health care and vacations and things like that, but they're done, and they spend less. And so I learned that I can take any country, take the birth index, and I have to adjust for immigration where that's significant, like the U.S. or Australia, project that forward 46 years to the peak in spending. You know what that indicator told me way back then? Greatest boom in history from 1983 to 2007, and then a bust from 2008 into 2022 before the next generation comes along. And, of course, that's what happened. So our first forecast, all the way back to the late 80s, was Homer Simpson, the typical baby boomer, was going to stop spending after late 2007 or so, and we were going to have economic headwinds for a long time, just like we had in the 70s and 30s, every generation. Now, but there's a second point that Robert correctly identified a long time ago as well. Our baby boomers are split into two sectors. The kind of 80 to 90% who are, a little above or below average, but there's that top 1 to 10%, even 20% if you stretch it, high college educated, who control 40 to 50% of the income and 90% of the wealth. Those people go to school longer, and then their kids go to school longer, so their whole family cycle doesn't peak until around age 54. Well, that was 2015, which says now we're going to start to hit headwinds in 2016, and the real demographic, the steep demographic cliff hits when Homer Simpson and the more affluent sectors are not spending because all of their kids have left the nest, and they're just spending money on travel and health care, and you can never spend as much money on that as you did, unless you buy a yacht, as you did, getting your kids through school and buying major house and stuff. So 2008 was the first warning point, and we've been having endless quantitative easing ever since just to combat that slide, and that can't work forever. And now central banks are going to see even the affluent people who've been pumped up by new record stock prices and bubbles and everything. That's all they've done is create new bubbles. They haven't created a growing economy again. Banks aren't lending substantially again because there's nobody to lend to. So it's all speculation. And now this third bubble after 2000, 2007, and 2015, and most stock markets around the world look like they've already peaked. We're the only ones contending with a new high in the best sectors of the U.S. Look like to me we're going to have the bigger crash is going to hit between right now into the next few years, especially in the late 2017 is my biggest danger cycles. And I think we're going to see a bigger crash than in 2008, early 2009. And everybody now finally says, well, no matter what happens, the Fed always prints more money and it comes back. I'm saying not this time. And so if I was advising, by the way, for somebody to run for president, my advice would be simple. Don't.
Because you're going to inherit that economy, right? You're going to inherit that crash.
Let the next candidate take it on the chin and then come in and be the Ronald Reagan or FDR that comes in when things are about to turn around and looks like a hero, whether you're good or not.
So you can vote for the person you really don't like because they're going to have a hell of a time.
Vote for the person you don't like. That's what I said.
Vote for
That makes it easier.
Anyway, I want to comment on what Harry just said, because when I read your book, The Great Boom Ahead and all this, it totally correlated to my study of demographics. Demography is destiny. And just a couple of days ago, I'm going through all my stuff. I'm a baby boomer. Baby boomers from 46 to 64.
60, yeah.
And I'm 47, so I'm going through all my stuff, and I was asking myself, why did I buy all this crap?
Yeah.
Why do I have all this stuff that was so precious, and now nobody wants it? So I was buying a lot of stuff because prices were going up, because baby boomers were in, as Harry says, peak earning, peak spending. They were accumulating, and so a lot of people have what I call collectibles. And a collectible, I have a friend whose mother was collecting all of these, I think, Norman Rockwell plates. And so that when she passed away, the daughter went there, and her mother was hoarding all these Norman Rockwell plates. And nobody wanted them.
That was the rise of the infomercial.
Right. Nobody wanted those Norman Rockwell plates. And so what Harry is saying, all you baby boomers out there, all that stuff you've been collecting, nobody's going to want, and they're not going to have the money to buy it. Am I correct?
Including trophy homes and speculative real estate and second homes you don't use. Hey, if you use your second home like I plan to 6 months a year, keep it. But don't have homes to use 5 weeks a year and park a yacht at or a boat at.
Hey,
it's
Harry.
Yeah, this is getting a little too close to home now.
You're kicking me in the you-know-what.
Hey, Harry. So, Harry, let me ask. So you're saying 2022, that's 6 years away. What's going to happen in 2022 that's going to change things, and what's the future for millennials?
Well, that's exactly the answer, because the baby boomers came along into a rising spending cycle starting in 1983, and the stock market bottomed just ahead of that in late 82, and that's what it is. Stock market's always a little ahead. And then they peaked in late 2007, and we've had headwinds since. The millennials don't come into their upward spending cycle until 2023, so I'm expecting the stock market to bottom or double bottom or something, to be basically the demographics kind of flattens out between 2020 and 22 and at a bottom for the baby boomers or the baby busters, it's better to say. And then the millennials come along and drive our economy up again. And, of course, it's a worldwide phenomenon. You can have emerging countries growing like crazy because they have demographics up the wazoo, with one exception, China. China does not have good demographics, and in fact, terrible by then. But the emerging world will be booming. The best countries like the United States and Northern Europe will be booming again, not as much as the 80s and 90s, of course, because this generation's not as impactful in their growth rates. But, yes, the next generation will always bring you out of a downturn, and, of course, they'll also bring better technologies and things the last generation could have never imagined.
Everybody listen to what Harry is saying. Like I said, when I read his book, The Great Boom Ahead, it was eye-opening to see the world from his perspective. And that's why this whole program today is Harry's calling for gold to go to $250 an ounce. And Jim Rickards, equally as smart, different point of view, is calling for gold to $10,000. And once again, all coins have three sides. Stand on the edge, listen to these very smart men, and then decide for yourself. But exactly as Jim is saying, in our neighborhood, Kim and I live in one of the most affluent neighborhoods in town, but those giant trophy homes are not selling. The smaller homes are selling. So a lot of things that the baby boomers cherished and held dear to them that they collected, like trophy homes and yachts, that's a low blow. But anyway, they're not as valuable anymore because the demographics have aged and they're not spending. Yep.
Right, and we haven't seen anything yet on that front.
I know.
This is just beginning.
Okay, so we're talking about the three sides of a coin and different points of view. So we've had guests on this show who talk about the crash as being going into like oblivion, and it's the Armageddon coming, and it's going to be civil war and all of this. When you talk about a crash, what do you see?
Every generation we see a long-term crash. 29 to 42 stocks were still down 80% in 42 before they turned around with World War I and World War II and the Bob Hope generation. Then they went up into 68 adjusted for inflation and went down into 82. That's a long-term downturn. So these things are not bad. We have booms and busts, inflation and deflation as part of the play of opposites that allows us to innovate and grow. If we don't get our ass kicked, we don't grow. We don't innovate. Anybody who succeeded long enough, or any corporation that has succeeded long enough, like General Motors in the 60s and early 70s, ends up getting complacent and doing poorly. That's why life has cycles, and everything has cycles, because that's what really matters, cycles and now demographics. Only since we had middle-class generations after World War II did demographics become the most important cycle, not only for boom and bust, but also for inflation and deflation. The baby boomers caused the highest inflation, not government spending, all of that was part of it, because it cost a fortune to raise these people before they became productive citizens. And that took until through the late 70s before the baby boomers got fully incorporated in the workforce, and then they have a spending boom. This is very simple, easy to predict stuff, and now that spending boom's over, and governments are trying to fight it with a fire hose of quantitative easing, and I'm saying it won't work, especially when the affluent customers, who are people who did benefit the most from quantitative easing and all the speculative bubbles, again, in real estate and stocks and stuff, when these people aren't spending, how are you going to stimulate with this BS money you're creating? It's 6 years before we bottom out, but I think the worst of the crisis by four different major indicators I have hits between late 2016 and early 2020. That's the real danger period. And since when you see bubbles burst like this, and you have to go back to the 60s was not a bubble economy. So the 70s was not a bubble burst. It was an inflationary recession. The 30s was a major debt and bubble burst economy. And the problem with that, and where stockbrokers are going to get it wrong here, asset allocation is worthless when everything goes down at the same time. And look at late 2008, the worst crash. Everything, gold, silver, commodities, real estate, large-cap stocks, small-cap stocks, European stocks, emerging market stocks, everything went down except for cash and the highest quality bonds. And the U.S. dollar, by the way.
So once again, Harry Dent is infamous. His website is harrydent.com, and he's calling for gold to go to $250 an ounce, and other guys are calling to go to $10,000 an ounce. And remember, Rich Dad always says there's good debt and there's bad debt. And intelligence is knowing the difference between good debt and bad debt. Any comments, Kim?
Yes, well, I really highly, highly recommend. Go to harrydent.com, and he has a free newsletter called Economy and Markets. It's free. It's a lot of great, great, great information you can get for free. And then he also has a new audio book, How to Survive and Thrive During the Great Gold Bust Ahead, at harrydent.com. So, Harry, there's a ton going on. We've talked about so much in terms of our listeners today. What would you recommend they do today, given what's coming down the pike?
Well, okay, you got to remember that the real peak, demographic peak of the baby boom generation was in late 2007, as we predicted a long time ago, and the second peak with the more affluent people who peaked later at age 54 instead of 46 was in late 2015. So we're now moving into the more serious time, and we're seeing signs. The China bubble, they will not be able to contain that. The Chinese government lost control, and wait until they lose control of their real estate bubble, the largest in history. We've seen the luxury markets, and I've been saying, hey, it's the affluent sector that's going to tank next time, not so much home. We're saying those stocks have been tanking in the last year. That's another sign. The U.S. economy came near a recession in the first quarter, something we were saying would happen, and almost all, if you look globally at stock markets, it's only the U.S. large markets like NASDAQ and S&P 500 Dow that are anywhere near their highs. The small caps in the United States are not, and all the rest of Europe, Japan, China, Brazil, India, none of those markets look like they have a chance of making a new high. It really looks like the market's topped in 2015, and the question is, when do we hit the first serious crash? And my best prediction of that is going to happen between mid-July and late this year. It's not going to be the full thing, but that's when we get something more than a 10-12% correction, and we could be down 20-30% or more in a short period of time. One of the things I warn people from looking, because I also study bubbles extensively throughout history. Bubbles build exponentially. That's why they're not sustainable. I hate to say it, they're just like an orgasm. I actually put all the great bubbles against the Masters and Johnson's orgasm chart, and it's eerily highly correlated. But here's the point. They build exponentially, but they burst at least twice as fast. And it's the first crack, when the bubble first cracks, like not late 29, and we just saw in late 2015 in China, and the first tech bubble, they burst 40 to 50% in the first 2, 3, 4 months. So I always tell people, get out of bubbles a little early. I know because it's very hard to predict exactly when that grain of sand is going to cause an avalanche on a mound. But once it happens very quickly. So it's better to get out ahead. Again, our danger zone, and I've got 4 major indicators. I don't have time to go over it. I've developed over 30 years, not just the demographic indicator, that all point down at the same time from mid-2014 to early 2020. That only happened in the mid-'70s and the early '30s, the 2 worst financial crises and stock crashes in the last century. So the danger zone is here, and I was saying in the previous segment we did that when you have a bubble burst instead of just a normal bull market peak like the late 60s, everything goes down. Stocks, real estate, commodities. So there's nowhere to hide except for the highest quality bonds, corporate AAA, and the best sovereign bonds, which I see right now as U.S. Treasury bonds. I think even Germany's in deep trouble because of Europe and Italy. Forget it. And in cash, just being in safe investments and waiting for the bubble to burst, because everything deflates. It's like a river going up to a cliff and then falling off a waterfall and then establishing and growing in a new lower area again. This is a good thing long-term for the economy because housing's too high for the next generation. Next generation, if they bought stocks at this bubble levels, even the best indicators say that you'd be lucky to make minus 2% a year over the next decade if you bought stocks at this level. And that doesn't take into account my forecast and demographic decline and deflation. That's just buying stocks at this level.
Well,
imagine real estate.
Yeah, we had Jim Rogers on, and he's tracking with you. He says right now the U.S. dollar is going to, his prediction is the U.S. dollar is going to be the last standing currency or the strongest currency. What do you say about that?
Yeah, that's right. The best house in a bad neighborhood. And I'm very bullish. I've been bullish on the dollar. I keep reminding Jim Rickards and Peter Schiff that the dollar's not crashing. It's been going down during the worst of the last crisis and even during the high stimulus recovery, which is counterintuitive, but it's been going up. And it is the best house in a bad neighborhood. And when there's a crisis like late 2008, the U.S. dollar spiked up 27% when gold went down 33, silver 50, stocks crashed, real estate, commodities, everything.
So let me
it's
ask
a good place to be.
Let me ask
for
this
a while, not forever.
But let me ask
the next
this,
2 years.
Right. Let's say you're holding dollars and you're getting 0 interest, right? It's still better
that's not
to be
what
holding.
I'm recommending. Well, you can hold dollars, get 0 interest, and you're preserving your purchasing power when things crash.
Okay,
You
good.
can buy things 10, 20 cents out. That's great. What's better is you buy UUP, which is an ETF, or a dollar bull fund. There's many ways to do this. You bet on the dollar going up versus other currencies. If you're holding that dollar, it's not going to appreciate it. If you're sitting in UUP the last several years, you're up 30, 40% when most things have been down and more volatile. So that's a way you can bet on the dollar versus other currencies, because the dollar has proven to be the very safe haven that the gold bug saw in gold. And the truth is, in a crisis, in a deflationary crisis, the leading currency in the world, the dollar goes up, and gold and all commodities and real estate and stocks go down. So where are you going to invest?
And what does UUP stand for?
It's the dollar index. It measures the U.S. dollar versus our 6 largest trading partners. And again, it bottomed in January 2008, exactly when the recession first started, the great financial recession. And even in all the money printing coming out of it and the recovery, the dollar has still trended up. I mean, it goes up and down, but it has trended up with not high volatility. It's been the best place to get a decent return, better than even a 10-year Treasury bond, but kind of similar. So that's where you go at a time like this. You can be in cash, flexible. You can be in betting on the dollar going up, UUP or some dollar bull fund. And you can be in the highest quality long-term Treasury bonds, and I wouldn't even buy the German Bund now. It's at negative rates or close, and Germany has the worst demographics, worse than Japan in the 90s in the next several years, and people are not going to believe what's going to happen in Germany, and Germany's supposed to hold up Europe, which is already failing. And mark my words on this, Italy is the next Greece, and by the end of this year, early next year, Italy is going to be in trouble, and there is no way to bail Italy out, and that's going to basically kill Europe and Germany and the Eurozone and the Euro. So the UK was basically, for whatever reason, more the migrants, smart to get out.
Once again, it's Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And all of our programs are archived at RichDadRadio.com. This is the most important part. This program is worth listening to 2 or 3 times again. As I said, the Rich Dad promotes 3 sides of a coin, heads, tails, and the edge. This is about standing on the edge. Harry has his point of view on the future of the world economy, and so do people like Jim Rickards and Peter Schiff and many other people. The difference is they look at the same charts and they see 3 or 4 different stories. So that's why all of our programs are archived at RichDadRadio.com. You may want to listen to, Jim Rickards' comments on why he thinks gold's going to go to 10,000. You can listen to Peter Schiff talk about why he talks about what he talks about, and you can Harry Dent. But also there was Jim Rogers, who is an American living in Singapore. We've had Richard Duncan, American economist who lives in Thailand. And they all give you their points of view. So all of our programs, again, are archived at RichDadRadio.com. Everybody's looking at the same charts. The charts are telling different people different stories. So, Kim.
Well, I've got to ask, Harry. We've got this election coming up in November. You're talking about the economy between July and December. So, from a demographic or psychographic or emotional point of view, what's the likelihood of Trump becoming president?
Well, first of all, he's surprised everybody all along the way. Second of all, if I'm right, my preferred scenario, which means the stock market starts to crash the second half of this year, and it gets more serious. Any stock market crash and any recession developing is always going to favor the non-incumbent or the non-establishment. That would favor Donald Trump. So, and if we do have a real crisis, an outsider and somebody as, I hate to say it, egoic as him and decisive would probably have more latitude. It's hard for an establishment person to make the type of radical change. I used to have to turn around businesses early in my career when I was consulting to them, and I found out, they were in deep trouble. I'd end up becoming the CEO for 6 months and have to turn around. You just have to make hard decisions. No more quantitative easing, and maybe this will work out in Pollyanna. You have to make hard decisions, make cuts, where to reinvest, and that's what we need. And like we said, we're looking for leaders, and I don't see any, and he's a little crazy on some stuff, like building a wall when the Mexicans are no longer coming, they're going back. They probably should be building a wall to Canada to keep people here from going out. And I can tell you, moving 11 million illegals out of this country alone would cause a deep recession, alone. and I'd rather find a way, a path to citizenship. But all of that stuff is just, and then if we have a more, I'll tell you right now, we're definitely going to have some sort of stock correction ahead. If it's more minor, like 10%, and we turn around and get one more grand stimulus program globally, and Mario Draghi in Japan, and then Yellen starts sending people $10,000 checks in the mail, and this is not out of the question, how desperate they get, then we get this crash next year, and it'll be deeper and longer. But any stability in the economy, or if stocks are still heading up again into the election, that is going to favor the establishment candidate, Hillary. And right now the polls would say Hillary's going to win. She's just less hated than he is. That's the difference.
And
the two most hated candidates, and she's at 46% hated, and he's something like 54. So that's the difference.
You also said, Harry, that there's a genuine voter revolt against the rich. Is that U.S.? Is that global? A voter revolt.
Well, again, it's both ways. That's why Bernie Sanders did so well as he did, even though he looks like Mr. Magoo and about to die or something. He was saying it's the rich, it's the 1% in Wall Street, and that's true. They've had almost all the gains for decades now. But Trump is saying, hey, it's also immigrants, especially illegal, and Chinese workers and unfair competition, and that's true too. Japan pushes down their currency on purpose to be more competitive. That is cheating. China doesn't pay pollution costs and all types of stuff we do, cheats, pirates, and does all, overstimulates, overbuilds their economy. They're cheating. And I agree. I mean, I wouldn't say we got to put up uniform tariffs. That's what they did in the Great Depression and made matters worse. But I would say to Japan, hey, for every percent you push down your yen by printing money or whatever you're doing, quantitative, we're going to put a tariff on your goods because it's just not fair. And I would have a policy, something like that with China. So he's blaming foreign competition, immigrants, and workers in Asia. And that's also true. That, I tell you, that has killed the middle class more than any other single factor. They were making great wages doing things that they've been doing for decades, and all of a sudden these Asian workers do it for less, even overseas, and then people come in from Mexico and other countries, but especially Mexico and Latin America, and they work for lower wages, and they're more motivated, and that puts downward pressure on wages. So the middle class has gone nowhere, actually down, negative since 2000, and they're back really to early 70s wages when you adjust for inflation. So these people are mad on both fronts. It's just the people who've been affected by the immigrants, go more for Trump, and the people who think Wall Street did it go more for Bernie Sanders. And I tell you, both extremes are right. That's why this is not a time for a middle road establishment candidate. That's why in the end, I would somehow say, God, Trump might sneak it out. But it's hard to see him do that in a good economy. So if I'm right and things crash earlier rather than later, that's going to favor the Donald.
Once again, Harry, thank you for always being a great host, great guest, great educator, and sharing your wisdom and knowledge. I mean, it's really, really gutsy to make a call and predict the future. And because, if you're wrong, everybody's going to say you're wrong, but it takes guts to call it. So thank you very much, and please come back at any time. You're always welcome. If you want something to say, give us a call. We'll give you that forum. Yes,
and please go to harrydent.com and get Harry's free newsletter, Economy and Markets. It's a great resource, always learning and always on top of what's happening today.
And I want to thank Harry Dent, economic forecaster. He's funny, entertaining, and brilliant. And as I said, he says things opposite of what a lot of other guests say. And as we say at Rich Dad Radio, all coins have three sides, heads, tails, and the edge. We've had Jim Rickard who's calling for $10,000 gold, and Harry Dent's calling for $250 gold. They're reading the same charts, and that's why we have Rich Dad Radio. You too should read the same charts and come up with your own decision, because it's about the future. Any comments, Kim?
Well, also I want to recommend he has a free newsletter called Economy and Markets, and that's a great way to learn as well. So that's at harrydent.com. And he also has an audiobook, How to Survive and Thrive During the Great Gold Bust Ahead. So both of those great resources. Go get them.
So for those of you who have questions for Ask Robert, submit your questions to AskRobert@RichDadRadio.com. And Melissa, what's the first question?
Our first question today comes from Emily in Tulsa, favorite book, Rich Dad, Poor Dad. She says, Robert, you talk about your love of gold. Why do you buy and hold gold? What is your strategy with gold and silver?
That's a perfect question at the right time. Everybody has a different reason. Like Jim Rickards has a different reason, and it's because they're printing too much money. Now, on the other side of it, Harry Dent saying they're printing too much money. That's why you shouldn't hold gold. And that's why you have to make up your own mind. My personal reason is this. To me, money is based on trust. If you don't trust your money or the dollars or your pesos or your yen or your French or euro, what do you trust? And I don't trust my government. I haven't trusted my government since 1972. So I always think it's funny that the U.S. dollar has "In God We Trust." That's not my gig. To me, that's false advertising. I mean, God doesn't bless the U.S. dollar. Give me a break. So I trust something that's been money for thousands of years. The price go up, the price will go down. But the issue is I buy something I trust. Gold and silver have been money for thousands of years. Any comments, Kim?
Yeah, well, it's interesting because Harry said you cannot take a Krugerrand and go buy groceries with it. Yet, back in 1988, I did take all of our bars of silver that we had stored in our closet and went down to the precious metal store just 2 blocks away and cashed it all in, and that was our down payment for our house. So I think you can go and buy your groceries and buy your houses and buy things that you need with gold and with silver because I've done it. We've done it.
And in 1972, I was this young Marine pilot in Vietnam, and I flew behind enemy lines to go buy gold from a communist mining company. And it was one of the most biggest wake-up. Here I'm risking my life to buy gold because I figured, I might be able to get gold at a discount behind enemy lines. Well, this little lady, little Vietnamese woman sitting there eating betel nuts with red teeth, the price of gold was the price of gold. It didn't make a difference if I was in a communist country or on South Vietnam side. Was I in North Vietnam or South Vietnam? She did not care. I tell you, that changed my life. Just standing there talking to her, she goes, "You get no discount. Today, I think it was $72. It's $72. I was kind of hoping I could buy it at 50. But she goes, no, 72. And that's what kind of changed my life. So some people trade foreign exchange, the dollar versus the yen, the dollar versus the euro. I'm not that intelligent. I just want the one price for gold. Now, this is the thing. If you're in, let's say, a weak currency, like today the rand is weak or the peso is weak, the price of gold goes up. If you're in a strong currency like the U.S. dollar, the price of gold comes down. So the whole point here is it's not in God I trust, it's in gold I trust. And all across the world, gold is one price. But it varies dependent upon the currency that you're using to purchase it with.
And one other story, our gold guy, Jerry, who we buy and sell gold and silver through, I remember him telling us a story of this couple, and they'd been all their life, they've been acquiring Krugerrands and Eagles and gold, 1-ounce gold coins. And now they're in their 70s, and he says every month they come in and they cash in one of their 1-ounce gold coins, and that is their Social Security, which is better than the Social Security they're getting from the government. So they used gold as their retirement, and every month they come in, cash it in, and they get their cash, and that's how they live. So again, I think gold is money.
No, it's gold is trust. Next question, Melissa.
Our next question comes from Luis in Fontana, California. Favorite book, Cashflow Quadrant. He asks, is going to college still a good investment in today's world for someone just out of high school who is seeking to start up a business?
Well, it depends on what you study. If I was going back to college today, which when I did, I went back to get I had to understand accounting. Because if you're going to be an entrepreneur, you've got to know accounting. And you got to understand business law so it's business and law. So the thing is what you study. If you study, organic pottery making, it probably won't help you. So anyway, it depends on what you study. Next question, please.
Our next question comes from Mark in Canada. Favorite book, Rich Dad's Guide to Investing. He said, I have watched many businesses close their doors in Alberta and their owners losing everything because of a bank asking for personal guarantees. This has made me appreciate the importance of being able to sell even more. Do you think personal guarantees will become a more prevalent requirement of commercial lenders, or will our ever-stagnating economy force said lenders to continue offering non-recourse loans?
That's a complex question. Let me say this. If you know how to handle money, banks love you. If you know how to use money and make money with debt, banks will love you. But you got to prove that on your financial statement. If you're an idiot and you don't know how to make money with money or debt, naturally the bank's going to hammer you. Do you know what I mean? Why would they lend you money if you're an idiot? So really, that's the question. Are you smart or stupid? I was stupid for years, but I got lucky a lot of the times. And I've also lost money. But it made me smarter, so today it's easier to get money. But you have to go through that point. So I'll say it again. If you're smart, the banks will lend you money. If you're stupid, they want every guarantee possible, including your firstborn and your mother-in-law. Any comments?
Well, my only comment is if you have trouble understanding what Mark is talking about when he talks about personal guarantees and non-recourse loans, that might be where you start your education right there.
But the good thing for me is I had no money, and Kim and I met. Interest rates were around 15%. So I couldn't borrow money anyway because at 15% interest, it didn't make any sense to borrow. So the thing is, adversity made Kim and I smarter. So it's a good question, but just realize if you really don't understand, everybody listening to there, if you're stupid, you're stupid. That's it. Next question, Melissa.
Our next question comes from Kelvy in the Philippines. Favorite book, Rich Dad, Poor Dad. Says, what do you think will happen to Saudi Arabia if the market crashes in 2016 since their oil is traded in dollars? And what would you suggest to those people who are working overseas, especially in Saudi Arabia?
Again, it all depends. I mean, if you're an armed guard and you've been trained by the Navy SEALs,
you'll be okay.
Everybody in the world is going to want you, because there's going to be probably chaos and mayhem and murder and violence. I mean, just look at every day in the world today, terrorists hit someplace. They just hit in Iraq. So terrorism's going to increase. That means if you're a Navy SEAL or former Green Beret or whatever you are, you'll always have a job. But if you're a wimp and you don't have any education and nobody needs you, you might lose your job. So it has nothing to do with Saudi Arabia or anything like that. It's how valuable are you and what do you know and what can you contribute at that time in history. Any comments, Ken?
Well, I would just re-listen to this show again because we're talking about the three sides of a coin, and part of your education and part of intelligence is being able to hold one point of view, a second point of view, and see what is best for your point of view. So listen to the show again.
So once again, I thank Harry Dent, our guest, economic forecaster. He's author of The Demographic Cliff, How to Survive and Prosper During the Great Deflation of 2014 to 2019. Listen to this program again because he says some very interesting things about poor people peak at 47 and rich peak spending at 54. I mean, those are demographics.